Good evening, ladies and gentlemen. I would like to welcome you to our investor briefing today. This week, we have a very special guest with us, none other than Evan Thwaites, Managing Director at IronRock Insurance. Evan is an associate of the Chartered Insurance Institute of the UK and went on to complete management training courses in the US, UK, and Germany to further his professional development in the insurance and reinsurance business. Over the past 30 years, he has contributed to companies like Globe Insurance Company of Jamaica, its predecessor entity, Globe Insurance Company of the West Indies, Grace Kennedy Financial Services Limited as a consultant. He has also served as a director on the Jamaica International Insurance Company Limited. All of this prior to forming IronRock, which went public with us, yours truly, Mayberry, in March 2016, if my memory serves me right. Welcome, Evan.
Thank you, Dan. Glad to be here.
Additionally, we have with us in studio our CEO, none other than Gary Parrott.
Afternoon.
And online, we have with us Chairman Christopher Berry. Welcome, Chris.
Good evening.
Great. So I'd like to jump right into it by asking Evan a few questions. And the first one is, Evan, tell us what sets IronRock apart from its competitors?
Dan, three things. And it was born out of my experience, long experience in the insurance industry. One, we use technology. It is the backbone of our business and our operations. Secondly, we only employ professional staff. And by that I mean people who consider themselves insurance professionals. And they're not just doing a job. And thirdly, it's our focus on underwriting and risk selection. We're very clear about the type of business we want to write, and we're very clear when we identified the terms and conditions that we would quote.
Excellent. Thanks for that, Evan. Additionally, what are some of the opportunities IronRock has chosen to capitalize on during this environment?
With the COVID pandemic, there are precious few opportunities. I'd say there are more challenges than opportunities. Certainly IronRock's focus from the very beginning has been the health and safety of our staff members and our clients. We were one of the first insurance companies to transition to working from home. One of the benefits of being technology driven. Secondly, we have from the very beginning tried to offer our personal lines clients tangible benefits to help them through what is obviously a pretty difficult economic time for most people. We've done things like we were the first company to offer 12 months of credit. Well, not really 12 months credit, 12 months to pay your premium. We offer our credit interest-free, no charges whatsoever. And again, with the technology we have, we were able to transition to online transactions immediately, seamlessly. And so that really has been the approach we've taken, the focus we've taken in the pandemic. I would say, though, that potentially it has presented an opportunity to us, and that's on the investment side of our business. There's no question that many investment assets, particularly stocks, are still depressed. The prices are still depressed. And we will be have taken and we will be taking more opportunity to align our investment portfolio in that way. If I can say it, one of the, hard to say, benefits in association with a pandemic, but one of the benefits actually has been our clients, not just IronRock's, but the insurance industry's clients, have had to transition to doing business online. The industry has had online facilities for years, but the clients have resisted using it. They sort of feel they can come in and speak to Miss Jones, who they've dealt with for 5 years, and they're going to get the best possible terms when they sit in front of her and talk to her. So the use of the online platforms has grown exponentially, as you'd imagine, as a result of the pandemic. For us, we have had our usage go up over 300% since the end of the first quarter.
Excellent. Excellent. Gary, over to you. Any questions from your perspective?
Sure. So, welcome to my fellow director. Chris and I
Thank
actually sit on the board of IronRock. And, the question I have for Evan today is, there's a feeling that with COVID, the pandemic, there are less people on the roads. So therefore, people would be expecting that, A, you would have less, you'd be able to give a rebate on that premium. And B, we should expect super profits from the company. Why is that not so?
Two things, Chris.
Gary.
Yes, there are much less traffic on the road, particularly when we first locked down the economy. There were virtually no cars on the road. So we at IronRock have seen a reduction in the number of accident reports, motor vehicle accident reports. In the industry, we talk about frequency. So we've had much less frequency of claims. However, the severity, which is now the size of those claims, has gone up significantly. Our assessment is, looking at data, looking at the details of the accidents we've had, we've come to the conclusion that because there were less cars on the road, people were driving faster, and therefore when they had an accident, they were having more severe accidents than previously. To give you an idea, our claims cost, we call it claims incurred, our claims incurred up to the end of the third quarter is tracking almost exactly the same as 2019.
Speaking of third quarter, Evan, I was pleased to see that your third quarter results are actually out, so congrats on that. And
Thank you.
from my look, it looks like your gross premiums underwritten grew by 27% year to date relative to last year.
Yeah, Dan, and we're really pleased about that. Frankly, it has slowed down, as I mentioned in the report to the stock exchange. We ended first quarter with approximately 50% growth. We ended second quarter, we were up 37% over last year. And now at the end of third quarter, we're 27% over last year. So COVID has begun to affect our growth rate. But given the economic conditions that we're operating in, caused by the pandemic, I can't tell you how pleased we are with the result. Particularly when you look at what's happening to other players in the industry. I saw the 6-month figures for the Jamaican general insurance industry. And at 6 months, 3 of our competitor companies had actually written less premium than they wrote in 2019 at the same time. IronRock, as at 6 months, had the highest growth rate within the industry. So very pleased with that.
Congratulations. Chairman Berry and Director of IronRock, as Evan and Gary have told us, do you have any questions for Evan?
Yes, welcome, Evan.
Thanks, Chris.
So, how do you see the investment climate looking forward, and how will that impact on IronRock's performance?
Actually, we are relatively optimistic about the investment climate. I think it's occurred to us, or we've realized, and I'm sure other people are coming to the realization, that COVID has not caused the sky to fall. We were all terrified at the start of this pandemic about what the consequences would be. But societies and people have adapted to the whole pandemic environment and the consequences. We have had pretty good investment returns so far this year. We were a little bit cautious to start with when the pandemic hit. We wanted liquidity. We were very concerned about liquidity. So we wanted liquidity. We built up our liquidity. That's caused our yields to go down a little bit, or should I say our income, not so much our yields, but our income to go down a little bit. But optimistic has come back into our investing philosophy. We're actually quite bullish long-term, quite bullish on stocks, and we have focused again on the income side, both for the stock portfolio and our fixed income investments.
Excellent. So when we talk about that sales growth, it leads me to wonder, what is IronRock doing to grow its market share within the market?
Dan, good question. I'd say to you, engagement with our clients. Just so that your viewers understand, in insurance, a lot of business is placed by insurance brokers. So in IronRock's case, about 90% of our business comes through insurance brokers, and another 10% comes from clients who insure directly with us, without the use of a broker. So we have really focused on client engagement on the direct portfolio. We have robust social media campaigns and a presence. Our marketing people told me that we're up 40% in the social media sphere. And then secondly, when dealing with brokers and their clients, our ability to transition, remember I mentioned we transitioned to work from home very early. We're now back at work from home because of the community spread. But because of our technology, because of our professional staff, it's brokers dealing with us are dealing with us seamlessly. We have effective and efficient communication with the brokers, and they indicate to us oftentimes that's not the case with our competitors. You can't get rapid responses to questions from other companies. We'll have to check and call you back, and it may take a day or two. So I think it's the fact that we're engaged with our direct clients, and the brokers have found dealing with us virtually the same, if not more efficient than before the pandemic.
Excellent, impressive. So we see you capturing market share in Jamaica. Can we expect the company to expand its footprint outside of Jamaica?
Yes, that is our long-term plan. However, I would say to you, we have a job to do in Jamaica that we haven't yet finished. Once we have accomplished what we've set out to accomplish in Jamaica, we'll certainly be turning our attention to the region. And again, we think our basic business model of tech-driven, creating efficiencies, our operating systems, our communications are all very efficient. Our professional staff, those two things alone will lead to success when we decide to expand regionally.
Thanks, Evan. And not to forget you folks online, if you have any questions, please feel to send them in. We'd be happy to respond to your questions. Gary, how about you? Any further questions?
Yeah, the question everybody asks an insurance company, underwriting profit. When would we expect to see consistent underwriting profits at IronRock?
Yeah, we all want that, Gary. But remember IronRock's business model. IronRock is focused. I tell our staff all the time, we don't net fish, we drop fish. We know exactly what type of fish we want to catch, so we just don't cast a net and scoop up whatever gets into the net. And that process of building a good portfolio takes time. We're not making underwriting profits, but it's not because the portfolio is full of bad risks. I'll give you a statistic. Our gross loss ratio as a company is 25%. The industry average is 32%. A couple more stats. Our average premium per policy is $299,500. The industry average, $116,000. When it comes to motor insurance, our average premium per policy is $146,000. Industry average is $43,500. Won't bore you with more, but there's one more I really like, and that's in property. $651,000 is our average premium. Industry average premium per policy is $416,000. So we're confident we are moving in the right direction. It would be foolish of me to open the floodgates to any and all types of business, quality of business to come in, especially given the fact that IronRock is only 5 years old. So we're cautiously building our portfolio and making sure that the risks we insure are those that we want to.
great. I think you're doing excellent for a company that's only 5 years old. I want to remind you folks that their gross premiums underwritten in 2016 was $127 million. And in the last year, that premium has grown to $701 million. So congrats. I think you guys are doing a great job there.
Thanks.
Chairman Berry, any questions from you?
Evan,
Yeah.
tell me about your philosophy on claims. You know, some insurance companies have a reputation that when it's time to pay, you have to pay, but when you have a problem, you don't pay. Tell me, what is IronRock philosophy on paying out when customers have a problem?
Chris, the whole reason that insurance companies exist is because our clients face risks which inevitably lead to loss, cost to them. There is no point being an insurance company if you are not going to embrace the philosophy of paying your clients' claims and paying them as quickly as possible. We go a step further, actually, than the rest of the industry. Many of your viewers might know that insurance is closely intertwined with all sorts of legal principles. Non-disclosure, I could rattle them off, they're all very technical. But we have taken the view that on the consumer side of our business, we call it personal lines, that we won't even apply those, some say draconian principles when it comes to people making a claim. We give our clients a pass. So a classic example, many people don't even realize that if you have a motor car and you don't keep it in tip-top condition, something happens, your brakes fail, you crash, you could get your claim denied because it's a requirement that your car be maintained in good working order. We had a client who had a claim, brakes failed, and she said to us that she had heard a squeaking noise, the brakes were a bit mushy, but she had scheduled a visit to the mechanic next week, but she had the accident before next week. We said to her, let's learn a lesson from this. Next time you have a mechanical issue, go sort it out quickly. In the meantime, we'll just pay your claim. It also holds true for businesses as well, and particularly in the difficult economic times we're in with the pandemic. People have a right to get their cash, and it's our job as an insurance company when they have a claim to make sure they get it as quickly as possible.
Thanks for that, Evan. We appreciate that. I continue to be impressed again with the growth, how well the company is doing. I'm not too sure if it has anything to do with two of your board directors that seem to be connected with Mayberry, or the fact that we brought you to the stock market, the junior market, 5 years ago. Either ways.
If I may be cute, it might be in spite of the two directors from Mayberry.
So in spite of Gary Peart, Mr. Peart, do you have a question for Evan?
No, I always have questions. You know, it's a business that some people are afraid of, etc. You know, so the question becomes: people look at an insurance company and don't understand that even their accounting is very different. And one of the questions, Evan, that people have had is, why is it we're not seeing a level of accounting profit from IronRock? But people say, boy, they're doing well. I mean, they can pay their claims. You know, what's happening? Or is there another indicator that an investor should look at to really, truly assess the value in IronRock?
Yeah, Chris, you raise a good point. Sorry. Gary, raise a good point. There are a number of accounting principles at play with insurance accounting. First off, revenue is essentially deferred. We call it unearned premium. But we're required by accounting principles to only account for the premium when the period has passed. And I'll explain a little more. A good example would be a premium that's a total of $365 for 1 year. When we book that premium in January, at the end of January, we can only take to our accounts $31 out of that. So you earn the $365 over the period of a year. And so if you wrote it on the 1st of January, you finish earning your premium in December. But if you wrote the policy on the 1st of July, you still have 6 months of premium in what's called an unearned premium reserve at the end of the year. In addition, on the cost side, as it relates to claims, we are required to do actuarial valuations of our claims liability. And essentially what that means in layman's terms is we have to add additional amounts to our reserve to account for claims that may possibly arise but which haven't yet been notified to us. All of which is effectively pushing cost forward and revenue backwards. Therefore, when looking at an insurance company, it's important that investors don't focus entirely on an income statement. The balance sheet is what really defines an insurance company and is the best indicator of how well an insurance company will do in the future. You've got to see growth in your insurance reserves, we call it. Those are our claims reserves, our unearned premium reserves. That growth translates into investment funds. Investments, if funds are invested effectively and properly, that translates into investment income and possibly capital gains. So bottom line is an insurance operation is really and truly a medium to long-term operation. An insurance company has to reach to a stage of maturity before you're going to see consistent underwriting profits. And in fact, an issue that many people don't realize is the faster your growth rate as an insurance company is the slower you actually add revenue to your income statement, because so much of that revenue gets put into the unearned premium reserve.
Correct. I agree with that. As a chartered accountant, I've always found studying the insurance companies a little bit tricky, but there are two things I find important. Again, over the last 5 years, they've grown their asset base from $600 million to $1.3 billion. So that's real cash money in the bank, set aside for the possibility of future claims. And you've grown your returned earnings to $500 million. So even after making your reserves, you're demonstrating that you still have good shareholders' equity left there.
Correct, Dan.
Free advice. When you're looking at companies on the stock exchange, consider Mayberry Jamaica Equities Limited. Facts, $12.2 billion in assets, $10 billion in retained earnings. There's no other equity traded fund or similar entity out there that can claim reserves anywhere near to Mayberry Jamaica Equities Limited. Back to you, Evan. I really do appreciate you being here. Chairman Berry, I'll give you one final question for Evan, but it has to be a hard one.
Okay, this is an easier one. So, lots of people make money on this thing they call insurance premium financing. Tell us, do you make any money on that? And how much?
No, we make no money on it. We provide that as a service to our personal lines clients.
Service, you mean free?
Yeah.
Free interest? No interest?
No interest.
Free finance?
Yep.
Who does that?
IronRock Insurance. Mr. Berry, it comes from a steely client focus. All of us who work at IronRock are in our own personal lives and our own outside of work environment, individuals who have issues, economic issues that have arisen out of this pandemic. The amount of money we could earn charging our clients for premium financing, we think is less important than the satisfaction we get and hopefully they obtain from getting extended credit without interest charges. That's our position on it.
Well, that's even more impressive, because if you're not charging up front and collecting that cash up front, it means this $1.3 billion isn't in fact from, earnings in the past. It's
Let me just expand on that, Dan. We also, as a consequence of COVID, introduced what we call installment premiums. So in fact, the income we reported, gross written premium that we reported as at 9 months, and let me say, we had a big take-up on it with our personal clients. So the income we report at 9 months does not reflect the annualized premium that we actually have written on our books. Mm-hmm. Written is the wrong term, but the annualized premium associated with the policies, because the installment premium works on the basis that we will debit you 1 quarter's worth of your premium. You pay that off. When the next quarter comes, we'll debit you another quarter's worth of premium. So we have a cushion of income that is yet to be processed and debited that will happen in the next quarter.
impressive. I've got some questions coming in online. First one comes from Shackman, Jamaica. I wonder if that's from a friend called John. His question is simply, what next for IronRock?
Our focus is increasing our profitability. As Gary pointed out, or alluded to, we have not yet turned an underwriting profit. That's our focus, our big focus. We would expect that to change in the next year or two, subject, of course, to the vagaries of the weather. We are in a catastrophe zone, so hurricanes can hit. In addition, earthquakes are another real big hazard we face. Subject to nothing catastrophic, no catastrophic claims, we would expect to have an underwriting profit in another year and a half, 2 years. That's the next focus.
Excellent. Excellent. I appreciate that. I can't let this forum close without getting a top pick from my chairman and from our CEO. So, Chris, from you first. What's your top pick for the week?
Okay, my topic for the week would be Wigton Wind Farm.
Wigton Wind Farm. Where have I heard that before? I went to that AGM today, I must say, and I am impressed with the boys down at Wigton. I think it's a great company with great potential, sitting down on $2 billion of cash. Yes. So I fully support that view. Gary?
So Dan,
yes, Chairman.
Dan, the last time I recommended it was at 80, and I noticed today it was trading at 70 cents, so it's a better deal than the last time.
I know what I'll be buying tomorrow. Gary?
Well, I think Chris took my pick, but I agree. I actually was going to speak about Wigton because the numbers that they've put out are just so phenomenal. And then the thing about Wigton, a lot of people need to understand is the day they announce another project, you would expect to see significant earnings increase going forward. So what you're seeing is a company that is making consistent profit, throwing off a lot of cash, and is in a prime position to get another deal, which will be much easier for them to finance because of the cash that they're generating.
Great. 2 more questions coming in. First one comes from David.
No, Dan, you can't let him off the hook. He has to give us a pick.
Oh, Evan has to give us a pick?
No,
Mr. Peart.
Oh,
my pick was Wigton.
He just piggybacked on you, Chairman.
No, I didn't.
Unacceptable.
I am recommending Wigton at 70 cents. He recommended it at 80 cents last time.
I see what you mean. I see what you mean.
So we both are saying the same thing for different reasons.
All right, good deal. On to the question from none other than David Rose. He's asking Evan about claims for the last quarter. He noticed that your claims went down. He wants to know if this is reflective of a general downturn in claims or if you think this is just a matter of timing.
Good question. It's actually 2 things. The claims we reported are net claims. That's claims after reinsurance recoveries. So a big part of that reduction is our effective buying of reinsurance. And so what we have done is by negotiating treaties and better terms on our treaties, we are getting our reinsurers involved in paying more and more of the gross claim, and IronRock is playing a smaller proportion. I looked at the claims figures just the other day, though, and in general terms, there is not a huge reduction in gross claims. Claims have not increased this year, and we would normally, with 27% growth at 9 months, we'd expect our claims to have grown, maybe not as much as 27%, but to have grown as well. But we're tracking very closely on a gross basis to last year. I dug a little deeper, and we saw a significant reduction in motor claims cost in the last part of the third quarter. So September, late August, starting from about the middle of August into September, we've seen a reduction in claims cost. Earlier I had spoken about frequency of claims going down, but severity going up. We're seeing frequency remain low, but in the last 6 weeks of the quarter, the severity also was much lower than we had encountered in the past. But overall, as I say, it's primarily more effective purchasing and arranging of our reinsurance treaties.
Good deal. And last question from online comes from Brother, and he's asking, Evan, do you plan to provide insurance to fisher folk? So I think he means to the marine industry, perhaps. Fisher folk suggests to me we're talking about artisan fishermen. And in general terms, the answer would be no. A man in Old Harbor Bay with a fishing canoe and an outboard engine, we have, as an industry, we have found that presents an unacceptably high, on average, that presents an unacceptably high risk of loss. We are, however, very big in what we call pleasure craft marine insurance. We have a sizable portfolio and a growing portfolio. And I see that as a very, it's not a large segment, but an important segment of our business. Very good. And this one's turning to Chairman and Gary Parrott from social media. The people want to know, does Mayberry plan to have its own trading platform similar to JTrader?
Well, we've actually gone through a process where we had it and we provided it to customers. And what we found is that over time, they didn't use it. And, so we encourage a lot of our customers to speak to their advisors, and we see more value coming from that perspective. So the answer is that we've done it in the past. The take-up wasn't that great, and we found that people got themselves into trouble as well. So, at this point, it's not at the forefront for consideration.
Thank you very much. Well, thank you, Gary. Thank you, Chairman. And most importantly, thank you, Evan, for joining us tonight.
Welcome.
To our viewers, thank you all for being a part of this month's Virtual Investor Forum. I'd like to also thank Evan, our special guest again, for updating us on the performance of his company. It's very impressive.
Thank you.
If I was allowed a top pick, it would perhaps be your company, but they didn't ask me. We're certainly looking forward to having you to another insightful month of our Investor Forum starting in November. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. Thank you all to the viewers for tuning in today. Keep safe, and remember, wise investors, slow and steady wins the race. Goodbye.